video is a part of our Capital Insight series for Punjab Capital Research, and this is our next edition of the Fundamentals to Noise series. Our Fundamentals to Noise series helps you distinguish between the noise and the fundamentals. And in this series today, we're going to be focusing on the Yen Successor. And we're going to try and understand as to why the Wall Street is borrowing Renminbi at a record pace and what Beijing's offshore engineering means for the global allocators. A funding currency rotation is underway. The offshore Renminbi borrowing has crossed Renminbi 300 billion year to date, more than double the pace at the same point in 2025. Itself a record year. Goldman Sachs alone has raised approximately 32 billion through dim sum bonds, making it the second largest issuer in the market behind only Bank of China. And the borrower list now spans Portugal, Korea Development Bank, Finland's MuniFin, Indonesia Sovereign, and a roster of European credit agencies. This is no longer an Asia-curio market. It's a global funding venue. There are three forces which are driving this surge, and each has staying power. First and foremost, the funding cost arbitrage has flipped. Chinese 10-year yields trade around 1.75% and Japanese 10-year yields have vaulted from 0.61% in early 2024 to above 2.4%. Offshore Renminbi has quietly inherited the role that yen played for 2 decades, cheapest funding currency in developed rate complex. The second force is that Beijing has built a captive demand pool. The expansion of the bond connect to insurers and other non-bank financial institutions channeled hundreds of billions of mainland renminbi into Hong Kong fixed income. With domestic yields compressed, that capital is yield-hungry, sticky, and unhedged. And lastly, what's important to understand is that the trade is synthetic dollar funding and not renminbi exposure. Goldman swaps proceeds into dollars and hedges currency risk. The bonds look Chinese, the liability is global. That is the institutional read, and it explains as to why every major dealer is following the same playbook. For allocators, the deeper signal out here is structural because Beijing is internationalizing the renminbi without opening the capital account. The offshore pool is becoming a parallel financial system, one that the global investors will increasingly need a position in, not just a view on. With this context, let's do a deep dive and let's try and understand what happens when the cheapest money in the world changes address. For roughly 2 decades, the yen was the global system's default funding currency. Borrowers issued in yen, swapped into whatever currency they actually needed, and pocketed a structural cost advantage rooted in Japan's long deflationary overhang. However, that trade is now broken because Japanese 10-year yields anchored near zero through 2023 have climbed above 2.4%. The cheapest yen edge has compressed into nothing. China inherits the seat by an accident of policy. Mainland 10-year yields sit at 1.75%, historically low for an economy of China's size, and a direct consequence of the weak credit demand, soft growth, and People's Bank of China that has kept conditions accommodative through property workout. In November, the Chinese 10-year yields fell below Japanese yields for the first time in modern memory, and they have stayed there. Now, what matters for the funding markets is not just the level alone, but the level after the cross-currency basis swap. The offshore renminbi is in a sweet spot, yields high enough to attract mainland investors starved of return, low enough that an issuer who swaps into dollars lands inside its US dollar curve. That spread is what Goldman is harvesting, and it's the same spread that every other large dealer is now positioning to capture. And this brings us to the plumbing that Beijing has built and why it matters. The supply story is well covered. Foreign borrowers are flooding in because offshore renminbi funding is cheap. The demand story is more interesting and more deliberate. First and foremost, we have the Bond Connect expansion. The Bond Connect is the channel that lets the mainland investors buy fixed income in Hong Kong. Until 2024, it was effectively limited to banks and a narrow set of fund managers. Beijing then opened the gate to insurance companies and other non-bank financial institutions, the deepest pool of long-duration mainland capital. Insurers in particular face a structural liability problem. They have sold guaranteed return products against 1.75% sovereign curve, and they need the yield. Offshore renminbi paper at 3% solves the gap. And then there is a duration mismatch, which is a policy lever. What Beijing has effectively done is open a release valve. Mainland institutions can now hunt for yield in Hong Kong without triggering the optics or the capital flight risks of broader account opening. The renminbi raised in Hong Kong is renminbi, but it sits outside the capital controls perimeter. That distinction is the entire design. From a borrower's perspective, the result is captive demand, a wall of mainland capital that is structurally short yield, structurally long renminbi, and increasingly able to deploy abroad. And from Beijing's perspective, the result is an offshore renminbi pool that grows without diluting the domestic policy framework. From a global investor's perspective, the result is new fixed income market that is roughly the size of mid-cap European sovereign and growing at a 100% annual clip. And you can see in this snapshot that the total dim sum bond issuance year-to-date through April 2026 pace is more than double the same period in 2025, which in itself was a record year. Next, let's do a deep dive into the Goldman trade. Now, Goldman Sachs has emerged as the largest non-Chinese issuer of the dim sum bonds and the second largest overall behind only Bank of China. The 32 billion renminbi that it has raised year-to-date represents roughly 10% of the entire offshore renminbi bond market for 2026. This is not opportunism. This is infrastructure. Let's talk about the mechanics behind it, the cost arbitrage that exists, and why competitors are also following the same strategy. When we are talking about the mechanics behind all this, let's try and understand that Goldman issues a 10-year dim sum bond with 3% coupon, finds enthusiastic mainland institutional demand, and immediately swaps the renminbi proceeds into dollars in cross-currency swap market. The currency risk is hedged. The underlying funding cost, once you net the swap basis, comes in below where Goldman would otherwise raise dollars in the US investment-grade market. The renminbi never reaches the firm's mainland China operations. It is fungible global liquidity. Which brings us to question as to why does this cost arbitrage exist? Mainland institutional investors are willing to accept a lower spread over the offshore renminbi curve than the dollar investors would accept over US treasuries. Essentially, they are not hunting for yield relative to risk, but they are hunting for yield relative to domestic 1.75% anchor. That gap between mainland China psychology and the global credit pricing is the alpha source. It will compress over time, but it is wide today. And finally, we have the competitors also following the same strategy. We have Morgan Stanley, we have Korean policy banks, we have Nordic export credit agencies, and a rolling list of European sovereigns and sub-sovereigns. The self-led issuance category, that is banks managing their own deals, has hit 47.5 billion renminbi year-to-date, also a record. When the largest dealers build issuance infrastructure, mid-tier issuers also follow because the syndication ecosystem has matured. The market is institutionalizing in real time. What can be said about this is that it's one of the cleanest funding arbitrages that is available to the global investment banks in 2026. It will close, but it is not closed as yet. Next, let's look at all this from the Chinese perspective and try and understand the offshore pool as a strategic architecture. Now, if we step back from the trade, then a larger pattern comes into view. Beijing has spent over 2 decades being told that it cannot internationalize the renminbi without opening the capital account. The conventional wisdom held that the reserve currency status required full convertibility, that without free movement of capital, foreign investors and the central banks would never hold renminbi at scale. What's happening in Hong Kong suggests a different path. By constructing a deep offshore renminbi market, one wherein the global borrowers can issue, mainland investors can buy, and proceeds can be swapped freely into other currencies, Beijing is building a reserve currency plumbing without ever touching the capital account. The renminbi raised offshore is not subject to mainland controls. The investors holding it are global, the borrowers using it are also global. Only the demand pool is structurally Chinese, and even that is diversifying. Let's also try and understand why this is not a near-term reserve story. The renminbi share of global reserves is still under 3%. It is not about to displace the dollar. But the dim sum market is creating something more subtle, a renminbi-denominated asset class that institutional allocators outside China can buy without engaging the onshore market access regimes. As that pool deepens, the calculus on small renminbi allocations and multi-currency mandates shifts. 5 years from now, a 1 to 3% strategic renminbi sleeve in sovereign or family office portfolio will not be exotic. It will be ordinary. Let's close this particular episode of Fundamentals Through Noise with the outlook. We are looking at a slow march of currency internationalization. The currency regimes do not change in headlines, they change in plumbing. The 1944 Bretton Woods Conference matters less to dollar hegemony Then the post-war euro-dollar market, which gives global borrowers a way to access dollar funding outside of United States. What is being built in Hong Kong over 2025 and 2026 is the early scaffolding of an equivalent euro-renminbi market. Depth, breadth, and a global issuer base, all without engaging the domestic capital account. Three signals will mark whether this scaffolding becomes structural. First and foremost, the foreign sovereign issuance breadth. Secondly, a credible offshore renminbi yield curve out to 30 years. Thirdly, the foreign investor share of dim sum holdings. So when we are talking about these three signals, none of the signals will arrive on schedule. All three are possible by 2028. The trade today for Goldman, for issuers, for the early allocators is to position before the architecture is fully visible. By the time the renminbi's reserve currency credentials are obvious in headline data, the spreads that made the early positioning attractive will be gone. The yen took 30 years to become the global system's funding currency. It's taking renminbi about 3. That's all that we have for you in this episode of Capital Insights. Stay tuned in for our next episode.